Now that we've got through the speculative options trade and a bit about option pricing, we're going to talk about what exactly a covered call is. We'll talk about putting the stock together with the option to make a covered call.
This is what we do.
Mm-hmm.
Yeah.
So let's look at an example here. JP Morgan stock is trading at $29.50 a share. I decide to sell a covered call on JP Morgan. Let's say it's the beginning of September. What I'm going to do is I'm going to go ahead and buy JP Morgan stock at $29.50 a share. I'm then going to sell the September 30 strike. Now that call is going to expire at the end of the month, right? The third Friday of the month. So I've bought the stock at the start of the month, sold the call, and the call expires at the end of the month, and receive a premium of $1 per share. The premium's paid by the speculator to me in cash. So what have we done? We've bought the stock at $29.50 and we've sold to a speculator the right to buy the stock from us at a price of $30 up to that expiration date. And for that right over our stock, the speculators paid us a premium of $1 per share, right? There are two possible outcomes here now that we've entered into this position. The first is the stock goes up and I have to sell my stock to the speculator. And the second here is the stock goes down and I don't have to sell my stock to the speculator. We're going to run through these two scenarios here. So if the stock goes up, the speculator will want to exercise their call. They're going to want to buy my stock and they're going to exercise their option. This is known as being called out, and that's an important piece of terminology, called out. If I get called out, I have to sell my stock at the exercise price to the speculator. So for example, if the stock's $32, the speculator is going to exercise and buy my stock at $30, and he's going to turn around and sell it at $32 in the market and make profit there. Is this a problem for me? Absolutely not. This is what we want. We want to enter a position and then get called out. We bought the stock for $29.50 and then we sell the stock for $30 a share. So we're going to make 50 cents per share on the stock sale. And we're also going to keep that $1 per share in call premium that he paid us at the start of the month. So our total profit here is going to be $1.50. And this is all on a per share basis. 50 cents plus $1 is $1.50. Or when you take that $1.50 and divide it by your investment, which is $29.50, 5.1% for the month. Now, regardless of whether you buy 100 shares of the stock and put $3,000, $2,950 into this position, or you put $300,000 into the position, that's your rate of return. And the rate of return is what's important. You're just going to buy as many shares as what relates to a reasonable diversification in your account, right? So the rate of return is what's important there. The second scenario here is the stock goes down. Remember, I bought the stock for $29.50 and then we sold a $30 call. If the stock goes down or it stays below $30, so on that day of expiration, if the stock's $29.50 or $26, anywhere below $30, the speculator will not exercise the option. The call will expire worthless. In this instance, we're going to keep that $1 per share that he paid us at the start of the month, or return a 3.3% for the month. Now here's the point where you need to detach yourself from what you've been taught about stocks and about traditional investing. The stock is now, and we now own the stock, we've kept the premium, and we now go into the management phase of the investment. And what the management is generating 3, 4, 5, 6% a month in cash flow off this position while it's down to keep compounding our assets, right, to keep growing our account until the stock comes back up and then we can sell it for what we paid for it and find a new position. And that one bullet point is the subject of 200 pages of our book. And that's the subject of 2 days of our seminar. How do you take the stock that's down in value and safely generate income on it? And that's really what Joe's developed over doing this over 25 years. We've been teaching these techniques for 8.
We're treating the stock as an income producing asset. We're not looking for the stock to go up. We're going to make 36, 70% per year. And nobody's going to consistently get that. There's not anybody on Wall Street that gets that consistently year in, year out. There'll be somebody that has a big hit sometime. They make a lot of money on a stock, but they don't do it consistently. And that's what's important.